It is Tuesday, February 3rd, 2026. And if you happen to glance at the pre-market tickers this morning, you might have done a double take. We are looking at a massive shock in the fintech world.
A huge one.
PayPal, PYPL, the original digital wallet, the company that basically invented online payments, has just seen its stock collapse. We're talking 16% in pre-market.
It is a bloodbath out there. There was no soft way to put it.
Yeah.
And for anyone watching the sector, this isn't just, a standard correction. This looks like a fundamental repricing of the business.
Usually a drop that big comes from one single piece of terrible news, a lawsuit, a hack, something like that.
Right, a single catalyst.
But today, PayPal hit investors with a two-punch combo. First, the forward guidance for 2026 is just dismal. It has completely reset expectations.
And second, a shock leadership change.
Yeah.
Alex Chris is out as CEO.
And Enrique Lores, who is the CEO of HP, is stepping in effective March 1st.
It's the classic clearing the decks scenario. You bring in a new CEO, you drop the guidance to the floor, and you call it a transition year, a kitchen sink quarter.
But for you listening, whether you own the stock or not, this is a perfect case study. We are watching a fallen giant trying to reinvent itself in real time.
It raises all the right questions about value investing, about value traps, and frankly, about the future of how we all pay for things.
Exactly. And before we really get into the why here, let's talk about context. Days like today can feel, chaotic.
Very chaotic.
It's hard to tell if it's a problem with one company or if the entire market is getting overheated.
That's the key distinction. You have to know the market's temperature. Is the whole bubble bursting, or did PayPal just trip over its own feet?
Which is why having the right tools is so crucial. We've been using the Buffett Indicator app recently. It's on the Apple iOS App Store. It's designed for exactly these moments. It helps you monitor market bubbles, gives you daily alerts on those big picture valuation metrics. It just helps you keep a clear head.
It's a great sanity check.
Yep.
Context is really the only defense against panic.
It is. So if you want to separate the signal from the noise, just go search Buffett Indicator on the App Store. Okay, so our mission for this deep dive.
Do it.
We're going to unpack this Q3 to Q4 financial whiplash, explain why this whole profitable growth story just died, and then analyze this pivot to agentic commerce.
Which sounds like something out of science fiction.
It really does. And then we'll debate the big question. At a 10 times PE ratio, is PayPal a bargain or is it a trap?
That is the billion-dollar question.
Okay, take me back just a few months, October 2025, because the frustrating part here is that the narrative was completely different. It felt stable.
We call that the head fake. In Q3 2025, the turnaround story really seemed to be working. Revenue grew 7% to over $8.4 billion.
And total payment volume was up too, right?
Right. TPV was up 8% to $458 billion. The engine was humming along.
And they even started paying a dividend, didn't they? That's usually the sign that a company is all grown up.
It was a massive signal. They started a quarterly dividend of 14 cents a share and committed to $6 billion in buybacks.
Okay, so let's break that down. When a tech company does that, they're basically telling the market what?
They're saying, we have matured, we are a cash machine, we're a value stock now. It's like graduating from the growth at all costs phase.
Right. It's like they're saying, we aren't the wild startup anymore, we are the responsible banker. So investors got comfortable with that.
And that comfort, that complacency is exactly why this morning's report caused such a violent sell-off. It just shattered that stable utility narrative.
So let's get into the damage. How bad was Q4 really? Or is this all about the guidance?
Q4 had some cracks, for sure. Non-GAAP EPS came in at $1.23.
Which was down from the quarter before.
Exactly. It was down sequentially from $1.34 in Q3. So it's already sliding. But that's not why the stock is down 16%. It's the 2026 guidance.
What did they tell Wall Street that caused this panic?
Well, analysts were modeling for about $5.73 per share in earnings for 2026. They were pricing in steady, continued growth.
And instead,
PayPal projected a mid-single-digit decline in GAAP earnings.
Wow. Okay, that is a massive disconnect. Going from expected growth to an actual projected decline. That's not a miss, that's a U-turn.
It completely changes the thesis for owning the stock. It tells investors the company is shifting from harvesting cash back into heavy spending mode. They're admitting they can't keep their position without a huge reinvestment.
So the profitable growth era is over. Or at least on pause.
It's on pause. They have to spend to survive, and that is going to crush short-term margins.
Okay, so let's dig into why they have to spend so much. To an average user, PayPal just works. It's a button. Why is that suddenly so expensive to maintain?
To understand that, you have to look at the take rate. It's the key metric.
And the take rate is the percentage of every transaction that PayPal gets to keep.
Exactly. It's the toll they charge for using their bridge. And it's compressing. In Q3 2025, it dropped to 1.64%.
Which sounds tiny, but on hundreds of billions of dollars, that adds up.
It adds up to hundreds of millions in lost profit. They're processing more money, but keeping less of it.
Why? What's driving that?
It's the conflict at the very heart of their business model. The battle between branded and unbranded checkout.
Okay, let's define those for everyone.
Branded is what you know and see. It's the yellow PayPal button on a website, or it's the Venmo app. It's high trust, and for PayPal, critically, it's high margin.
That's their cash cow.
That's the cash cow. But that cow is getting fenced in by Apple Pay and Google Pay.
Because it's just faster to use the payment system built into your phone.
It's loader friction. Double-clicking your iPhone is just easier than logging into PayPal. So that branded growth is slowing down.
So to keep the overall revenue number looking good, they have to lean on the other side of the business.
The unbranded side, this is their service called Braintree. Think about when you pay for an Uber or an Airbnb, you don't see a PayPal logo anywhere.
Right. You just put your card in.
And Braintree is the plumbing that processes that payment in the background. It's the invisible infrastructure.
Yeah.
And it has huge volume. But here's the catch.
Lower margins.
Much, much lower margins. It's a commodity business. They're competing with giants like Stripe and Adyen purely on price. So PayPal is stuck in this mix shift trap.
Explain that, Trout.
Their total payment volume number looks great because Braintree is growing so fast.
Right.
But because more and more of that volume is the low margin stuff, their overall profitability per dollar is sinking.
Ah, I see. It's all growth. The top line looks bigger, but the quality of that revenue is getting worse.
Precisely. And the old CEO, Alex Chris, he tried to fix this, but clearly the board decided it wasn't working fast enough. They pulled the ripcord.
Which brings us to the leadership change. Alex Chris out, Enrique Loris in. I have to ask, Loris ran HP, the printer and laptop company.
The very same.
Why on earth do you put a hardware guy in charge of a struggling fintech company? It feels like hiring a plumber to fix your wiring.
On the surface, it's a total head scratcher.
Yeah.
But if you look at what Loris actually did at HP, you start to see the board's logic. He didn't just sell boxes.
He did all those subscription services, right? The ink subscriptions.
Exactly. He pushed instant ink and recurring revenue models. He took a transactional business and tried to turn it into an ecosystem.
So the board doesn't want him to build hardware. They want him to replicate that business model shift, move away from one-off transaction fees.
That's the theory. They want aggressive innovation. And this aligns perfectly with the new buzzword they're pushing, agentic commerce.
Agentic commerce. Okay, break that down. What does that actually mean for me as a user?
It means they want to stop being a checkout button and start being an AI agent that shops for you.
Okay, that sounds like a huge leap. So I'm trying to buy sneakles. How does that change the experience?
Well, think about the data PayPal has. They call it their transaction graph. They have 430 million accounts. They know what you buy, when you buy it, everything.
That is slightly terrifying, but I see the business value.
The play is to use AI to predict that you need sneakers. They just launched PayPal ads. So the idea is they serve you a personalized offer, say 10% off those Nikes, right inside the PayPal or Venmo app.
So they're trying to move up the funnel. They want to be where shopping starts, not just where it ends.
That's it exactly. If you click that ad, they get the ad revenue, which is high margin, and they get the transaction fee. It's a brilliant solution to the margin problem, in theory.
In theory. But that's a huge behavioral change. I open Venmo to pay my friend for dinner, not to go shopping.
And that's the execution risk. It is a very heavy lift. Do people actually want their wallet trying to sell them things? That's the bet Loris is being brought in to make.
Speaking of Venmo, where does that fit in? Is it actually making real money yet?
It's growing. Revenue was up 20%. They're pushing the Venmo debit card and pay with Venmo to try and, monetize it beyond just sending money to friends.
And what about buy now, pay later?
That's a double-edged sword. Volume hit around 40 billion, which is huge. But we also saw their credit losses grow to nearly $500 million. Lending is a risky business.
So it's a company in a very messy transition. New CEO, risky new strategy, fighting off the biggest companies in the world. Now let's get to the valuation, the part our learners really care about.
The numbers are fascinating. This is where the debate gets really heated.
After this crash, PayPal is trading at about 10 times forward earnings. In tech, that's just basement level pricing.
It's incredibly cheap. For context, Visa and MasterCard trade at nearly 30 times earnings. PayPal is being priced like it will never grow again.
But the cash flow is still strong, isn't it?
Very strong. And this is the key point. We're looking at a free cash flow yield of around 12%.
Can you explain free cash flow yields simply for everyone listening?
Sure. Think of it this way. If you bought the entire company today, that 12% is the cash profit the business would put in your pocket each year, ever all expenses.
A 12% return, that's a number you see in dying industrial companies.
Exactly. Tobacco, coal, industries the market thinks are going obsolete. So the market is pricing PayPal like a cigarette company.
So let's build the bull case. Why would a value investor look at this and see an opportunity?
The bull case is simple. You have a business that generates $6 to $7 billion in free cash every year. They're using that cash to buy back $6 billion in stock.
So they're shrinking the number of shares, which pushes up earnings per share for everyone who remains.
Right. And at 10 times earnings, you are paying for zero growth. You get the agentic commerce AI strategy for free. If Loris gets it to work even a little bit, the stock could re-rate to 15x or 20x earnings. It could double.
That is compelling. You get paid to wait. But what's the bear case? Why is the market so negative?
The bear case is that this is a classic value trap.
The melting ice cube.
Yes. The bears believe the low multiple is justified because the business is structurally broken. They think Apple and Google have an unbeatable advantage because they own the phone.
And that the high-margin branded button will just slowly fade away.
Exactly. And in that world, PayPal is just a low-margin processor. The buybacks and dividends are just a way to keep investors happy while the ship is sinking. They see PayPal as the next BlackBerry.
And this new guidance, projecting a decline in earnings, really feeds that bear case.
It's the primary evidence for it. The market hates a shrinking bottom line more than anything.
So it's a paradox. You have a cash printing machine that the market is treating like it's on life support.
That sums it up perfectly.
Yeah.
So Enrique Loris has this monumental task ahead of him.
He has to turn a digital plumber into an AI commerce engine.
And he has to do it while Apple and Google are actively trying to make him irrelevant?
No pressure?
None at all. Just the fate of a $60 billion company hanging in the balance.
Well, that brings us to the end of this deep dive. It's a fascinating situation. High cash flow, low valuation, but extremely high uncertainty.
It's definitely not an investment for the faint of heart. You have to have real conviction to step in front of a falling knife like this one.
And before we sign off, just a reminder. If you want to dig into these numbers yourself, and you absolutely should, the links to the deep value research reports we used are in the description.
And if you want the full breakdown or to join our community discussions on topics like this, check out the Deep Value Club membership or subscribe to us at deepvalues.ai.
It's a great place to break this stuff down daily. Now, we always like to leave you with one final thought to chew on.
We've talked a lot about AI and business models, but let's zoom out. PayPal is offering a 12% cash flow yield. It is effectively paying you to wait for a turnaround. But here's the existential question. In a world where your phone's operating system, your iPhone, your Android, is your wallet, does the world still need a middleman like PayPal?
No matter how much AI they add.
Right. If the phone is the wallet, is an app just an extra step that we are all eventually just going to skip?
Is it a feature or is it a standalone business? That's the question that will decide everything here.
Exactly.
Thanks for listening, everyone. We'll be watching the tickers.
Stay curious.